My first real estate investment was a 32 unit apartment building, and that thing just put cash in my pocket like clockwork. In 3 years between '02 and '05, I was making enough money that I quit my job. In the last 18 months, we have grown 33% or more off of a $7 million revenue. We're going to continue growing at a double-digit pace. 70% of my net worth is in multifamily. Some people might be like, oh my God, that's way too much. Yeah, but I've been doing it for 20 years. If I buy a $10 million deal and put $3 million down, I'm going to basically be able to write off the entire purchase price of the building and my down payment in year one. We're paying virtually no tax.
There are a lot of things that I find interesting about you, but the only thing I don't like is Brad Sumrok. Brad, we met at War Room not too long ago. And I think, did we meet through Pete Vargas?
Well, I think we did. I think we did meet through Pete Vargas.
Great guy, a great friend that I've known for 20 plus years at this point. And there are a lot of things that I find interesting about you, but we'll kind of slow walk into them. The only thing I don't like is that your name is Brad. And generally speaking, I don't hang out with other Brads because I feel like it steals my Brad spotlight. But I had to make an exception this time because you have a really cool business and a lot of experience that I think would be helpful to a lot of people here.
Well, I noticed here in the interview that my name is Bradley, and nobody calls me Bradley except my mom. So, like, and my mom's not even here with us anymore. So, like, I'm Brad, you're Brad. It's all good. You see, I had the opposite. When I met you, I'm like, dude, you have the coolest name, man.
Well, it just tells you something about my arrogance, I suppose. But jokes aside, you are really good at multifamily real estate. And I want to dive into some investment strategies with you. But outside of I think you have over 8,000 units that are multifamily buildings that you are responsible for. And you're syndicating deals on a routine basis. So you're actively investing. And that is a big part of your life. But on top of that, you're teaching people that business. You have an education business that's an 8-figure education business to teach people that. Is that all accurate so far?
That's you hit it. You hit the nail on the head.
So one of my favorite things and one of my least favorite things in life are people that try to teach things when they don't do them or when they used to do them and no longer do them because things change. So I love talking to people that are actively investing and actively teaching. I think it's a really relevant frame for anybody listening or watching because you get to learn from an active, successful investor. And the proof is in the pudding. And part of that is that you built a big education company helping people do the same. So before we get into the real estate investment side of things, can you tell me when you started the education company and kind of what the framework is for it?
Yeah. So, a little history there is long before we started an education company, we became our own success story. And I loved what you said about people that teach. And I agree, because there's so many people teaching. Maybe they did 1 or 2 deals and they had some success. But, my background is engineer, MBA, struggled in corporate America for 14 years. And I actually started as a real estate investor by going to a real estate seminar. And at the time I was like totally skeptical because up until then I was just thinking about formal education. I didn't understand the value of seminars and self-education. And so, I was very skeptical, probably the most skeptical one in the room, went to a seminar. And 8 months later, after going to a seminar and then engaging that organization as a mentee, they offered me a mentorship program. I didn't tell anybody about it. Like, I was embarrassed, right? And so my first real estate investment, Brad, was in 2002, and it was a 32-unit apartment building. It wasn't a single family home, a 4-plex, a duplex, a 10-plex. It was 32 doors under one roof.
Wow.
And that thing just put cash in my pocket like clockwork. And so that was 8 months after the seminar. I took the seminar in '01, bought my first deal in '02, bought my second deal in '03, bought my third deal and retired in '05. So like within 3 years of, being skeptical, going to a seminar, buying my first deal, within 3 years, I was making more money from my apartment investments in terms of cash flow and paying less in tax because of the preferred depreciation benefits that we get in real estate. And so within 3 years between '02 and '05, I made enough money and was making enough money that I quit my job. And so at that point, my original real estate mentor actually brought me onto his team. And I was mentoring people with him for 6 years, from '06 to 2012. And I was still accumulating deals and doing deals, but I was also helping him expand his platform. And then in 2012, I left him, and me and my wife started our own platform in 2013. So, I've been mentoring people for a long time, but what I love to tell people is my first success story was myself. And see, I believe that to my core, that the first person, whatever your skill set is, when you start teaching other people, you have to have done it for yourself, right? Like
Yeah.
if, like I would never go hire a fitness trainer that learned from a book if they were 50 pounds overweight. But even if they were really good, book smart, I'd be like, dude, you're not walking the walk.
Right.
I mean, you're talking the talk, but you're not walking the walk.
Yeah.
So yeah, that's how I got down the mentorship path. And I just found that was like, and it still is, by the way, after 20 years, it's extremely fulfilling for me to take somebody that is not financially free, that has a job, that pays a lot of tax, and to be able to move the needle for them and have them, have cash flow from their investments and pay less tax. And ultimately, some people, hundreds of my mentees have quit their jobs.
Yeah, I love it. So 2013, you started the company. What was the, and I want to frame this appropriately, because as you're actively investing, needless to say, that takes time and energy and focus. But as you're building the business, what was the general growth rate of it? So it's an 8-figure company now. Did it start slow? Did it start off huge? How did you launch it? What did that look like? And how's it changed?
Well, yeah, that's a great question. And so, if you remember part of what I just shared, for 6 years, I was mentoring people in basically my mentor's organization. So I was already, they say, well, what is an expert, right? 10,000 hours in a subject. So I was already an expert. I'm saying an expert. I guess that's what they would say, right? I was already an expert because I was investing from '02 to '13. But then we started our own company. And Brad, we had to learn, in my organization, I was an employee, and he would do all the marketing, all the advertising. He would fill the room. He would make the offer from the stage, and then I would fulfill the product. And all of a sudden, now me and my wife are launching our own company. So we got to learn the marketing, the sales, the advertising, create an offering, deliver it from the stage or from a funnel or from whatever, which we're doing all of that now. And I could just say the first year in business, we did under $500,000, but I was really I think we did like 400 or 500K, but just under $500,000 in 2013. And I don't know the exact rates, but it went from, say 450 to maybe 1.2 to 2.8 to 4.6. And then we kind of plateaued around 7 million. And that was our plateau. And we kind of stayed at that level for a couple years, but then we found a new mentor, and that was the gentleman that you mentioned in the beginning of when we started our conversation, Pete Vargas. And so, Pete now is like a strategic advisor for me personally and for our organization. And just in the last 18 months, we have grown, 33% or more off of a $7 million revenue. So we're on this upward trajectory again. So, awesome. Yeah. And I'm excited because we have big plans for the next 3 to 5 years to continue growing at, we're going to continue growing at a double-digit pace, put it that way.
What do you think caused the plateau, and what do you think Pete contributed that helped break it and accelerate past it?
Well, yeah, this is going to be a great infomercial for Pete Vargas, right?
Well, we'll get Pete on to talk and promote himself too. He's very good at that. But I know that Pete has a lot of success stories, so it's I don't feel bad about that.
Well, here's the deal. I don't either, and that's why I mentioned it. But here's the deal. Whenever in my life I felt like I was at a point where I could do it on my own, I've plateaued. So that could be in that's in my apartment investing business. In my investing business, I got stuck. I was comfortable doing $20 to $30 million deals. And then I met a guy and I became his friend, and he, kind of took me under his wing unofficially. And we did $100 million deal together. And now I learn from him and I watch him, and I went to Grant Cardone and I paid Grant for one-on-one mentoring sessions. And I wasn't asking Grant about apartments because he does apartments too, but I wanted to have proximity to Grant because I wanted to know how he thinks so big, how he's so confident in his mindset and how he just thinks about doing big things. And so every time I go to Grant Cardone, I walk out wanting to do a bigger deal. And so it was the same with our education business. We just we got to a level where I got comfortable. I stopped growing. I thought I knew everything I needed to know, seriously, and we plateaued. And then, one dot led to another, and that's when I was introduced to Pete, and I learned that oh my gosh, there's so much more out there. And Brad, that's where we went, because Pete also encouraged me. He said, Brad, you need to be in some of these other masterminds where you're not the biggest fish. Like right now, like for a while, I was the biggest fish in my little fish bowl. And so, there's always another level. And you need to learn from people that are 1 or 2 or 3 levels above you. And so whether that's been like I know you love to work out, and so do I. I'm on day 51 right now with 75 hard. And, when you want to take your physique, your health, your energy, your business, your investments to the next level, you need to be playing with people 1 or 2 or 3 levels above you and learning from them.
Yeah. Yeah. I completely agree with you on that front. It's more comfortable to not do that, right? To avoid the confrontation, avoid people questioning your beliefs. And it's also easy to settle into this idea that your business is special and unique, and the nuances, and the outside people that are giving you advice just don't know the details. On a lot of levels, business is the same. Every business has sales, marketing, operations, some form of technology today, more than likely. And then the back end, you have to deal with the taxation side of things, which only becomes relevant as you get bigger. Yeah, I love hearing that. So was it specifically access to new people that you think helped break through, or the specific tactics that you started deploying? Was there a specific strategy that helped create that?
Yeah. So yes. And just to go back to when we started our new company in 2013, I mentioned I was already an expert in apartment investing, but I didn't understand marketing and sales and filling in the event business. Mm-hmm. And so we had a mentor back in 2012 and 13 that we learned how to speak from the stage and how to, fill the room, and then how to convert people from an event attendee into a high ticket client. And so that really moved the needle and got us to a certain level. But then when I met, like I said, we stopped learning and growing for a year or two, and we plateaued. So here's the deal. We met Pete, actually through the Grant Cardone folks, because they work with Pete. Mm-hmm. And so what turned out to be just an introduction, what led to a business arrangement between Pete's organization and mine. And so Pete Pete works with some of the biggest and best names in the world. He works with Grant Cardone, Tony Robbins, Dean Graziosi, just to name a few. And
all our clients.
And he's out there, like, he sees what works with them.
For sure.
And so, the things that work with them, he's able to share with us, because a lot of what's working with them are his strategies. And so I think part of it is strategy, knowing what's working right now, and see what's working right now is not what worked last year doesn't work right now. And there's so many parallels, Brad, because like with apartment investing, if I approached apartment investing the same right now as I did last year or even 6 months ago, I would have limited results.
Yeah.
Because so many pivots are happening, rent growth, inflation, cap rates, the tax laws are changing at the end of 2022, right? Just to go down that direction. So by being tied in with somebody that is constantly innovating with some of the best people in the world, then we benefit from that. So we're benefiting so we're not having to reinvent the wheel. And when I was running the company on my own without an outside advisor, I didn't have the luxury of knowing I could go to Grant Cardone's events or listen to Dean Graziosi make an offer on a webinar, but I didn't have the data and the science behind what's working right now.
When we look at what works and what doesn't, part of what you're saying from an info product business and any business perspective, but a live event business, is we just went through COVID. And so how you handle a live event in the COVID era and post-COVID is all changed radically. And I'll stop promoting the hell out of Pete Vargas in a second here, but he did an amazing job of transforming live events to virtual events through the pandemic. Unbelievable. And as you mentioned, we have a number of mutual clients, Easy Pay Direct and Pete, and he helped them grow these crazy virtual stages, Tony Robbins, Dean Graziosi in particular, during that time. So I get that in the transitional nature of the times. Can you give me like a specific tactic that is working today that wasn't working before, or something that you changed specifically?
Well, so last year, for example, there was the challenge, right? If you nobody heard of it. I never heard of a challenge before I started working with Pete, and all of a sudden now everybody's doing challenges. And what a challenge is, it's a free virtual event that might be multi-day, like for example, a Monday through Friday challenge, where you deliver tons of free information for 1 or 2 hours a day. Tony Robbins does this, Grant Cardone does this, Dean Graziosi does it, Brad Sumrok does it. And so the idea of the challenge is to engage people and deliver tons and tons of content. And then during that challenge, you make an offer for maybe a low ticket sale, like, hey, come to my event. Or maybe it's like, hey, click here for a one-on-one strategy call. So whatever that is, there's a free event where you're delivering tons of value. By the way, that's the challenge. Mm-hmm. And then at some point during that challenge, you make an offer for we could call it an upsell, or it could be a low ticket offer, or it could be a strategy call that might lead to a higher ticket, like a coaching program. And here's the thing: last year, challenges were all the rage. Like anybody that would do it, it was new. And so like the first challenge we did, we had so many people. It was so easy. And, we had all of these people because everyone's like, oh my God, it's the first challenge in apartment. I think we probably did the first challenge in the apartment investing segment. And now everybody and their brother is doing challenges, right? Mm-hmm. And so if you do a challenge in 2022, the same way you did it in 2021, you're going to have diminished returns. And so, we're going to gear up for our next challenge in the first week of April. And I'll be honest, because I just got off the phone with a strategy call today, but we're going to still do a challenge, but we're going to approach it entirely differently, Brad. So that's just one example of I never did a challenge before 2021. That was a big deal that we pivoted, that brought more people to our, we got more awareness, we got more content, we got more opt-ins, we got more lead gen, and a lot of those people converted. But now we have another challenge coming up and we have to approach it differently. And so again, Pete's the guy that I aligned with. And I love giving him credit, but I also want to say that without having a mentor, okay, and that's what Pete is to me, he's a mentor that we pay and we have a business arrangement. It's very simple, right? And so without having a mentor that like, cause I'm looking at running my company. I don't know what everybody else is doing with challenges and what's working right now. And so if we didn't have Pete as a mentor on our team, then we'd be left to figure it out on our own. And I'd probably do it the same way I did it last year and then have diminished results. Does that make sense?
Yeah, totally. And I don't want to beat a dead horse here, but what's in your head in terms of how you have to do something differently for this challenge this year versus the last one? What are a couple things that are like, oh, this is the thing I need to lean towards, even if it's not specific?
A couple things that I do know, and I have a team that probably could answer some of these things better, but like ad spend right now is crazy. And they keep changing the ad algorithms, right? And so in the past, we could spend a lot less money and have more people from say Facebook ads. And so pivoting on ad strategy. And again, I'm the owner of the company. So some of the strategies I get lost in the weeds in, but I know that we can't just rely on Facebook ads now. So now we're okay, well, how do we get more affiliates promoting our event, for example? And what could we do with referrals for our current clients and maybe enroll them in a process and have, and have them promoting our events? And what about some service providers or vendors that we could have come on the event, or guest speakers that they come on for free and promote our event, and they get exposure for their funnels or something. So these are just some different ideas of because if you just rely on paid ads, our first challenge, we basically did paid ads and then we marketed it to our email list and we had a great result. And now that strategy won't work anymore. So I want to make sure I'm answering your question and giving some content. So, yeah. And I could probably give some other examples as well. And yeah.
I think that's great. I mean, for me, I think it's very valuable for people to just like you have leaned on Pete to help guide you towards the things that are working right today. What's working, what's not, because he has context. You have context for what you've had to change in your business, in the 8-figure range. And we have tons of people. I mean, Easy Pay Direct is probably the dominant information product and seminar payment provider out there. And we do all of the names that have been mentioned, we process for, and tons of people that are in the, million, 2 million, 3 million range that are confronted with the exact same thing that you just said. So your experience of that is tremendously relevant. People struggle in all the different areas, right? But sales and marketing certainly is one of them. And what you just mentioned, ad costs rising and Facebook changing their algorithm and iOS 14 and all of those nuances are a big struggle for people. So how you navigate through them and how you've done it, it's super helpful context.
Yeah. And then what we found too is and here's where I don't want to mention names, but there was one person that we were using for, Facebook ads that in the beginning was really good. But after a while, we found that, we needed to use somebody else because that other person we were using, a lot of our ads were getting rejected and it was taking more time. And then we found, through, again, not only through Pete, but through other people in the information space that are high ticket sales that run ads, right? There's so many digital marketers out there. We found that we needed to pivot with an ad agency and so, that's again, I'm not saying you should never keep using the same person, but you got to be looking for the pivot, and you got to be, when you're getting diminishing returns, you got to investigate and say, hey, why are we getting diminishing returns? And then what other strategies could we do? So another one, and I know you asked me, another one that we got from Pete that we're implementing now is we're going to rely more on, like an evergreen funnel, come out with a core training and drive people to that funnel that, again, has tons of content. And it's the same concept of a challenge is create content and drive people to it and have a call to action. But a challenge is a production. I mean, it's a 5-day live event, 2 hours a day, and you need to be in a studio with cameras and sound and, and I got to be on stage, a virtual stage, which is harder to, interact with virtually than it is with live stage, right?
Totally.
an evergreen webinar is like you create some kick-ass content that's time sensitive and relevant, and that has, a catchy title, but then you deliver time sensitive, relevant content. And in that webinar, there's a call to action. So now I don't have to be doing live events all the time, and I can be using technology to market that content that could lead to a call to action. And again, that call to action could be a variety of things. It could be, a call to develop a strategy call where you have a salesperson, or a consultant that could walk them through an implementation plan and convert them into a higher ticket program. Or it could be, a low ticket offer where the webinar leads to a call to offer to come to a live event or something like that. So these are all things that we're doing now that we didn't do last year.
So, okay. So I want to shift gears and talk about your area of expertise for 20 years as opposed to the last 5, which is when you've gotten really good at this side of business. But for the last 20, you've been buying apartment buildings, and starting with, as you said, a 32 unit apartment building. And your model has been buy existing, improve, and either hold and or refi or sell them. I have tons of interest in this. Like, I have just a tremendous amount of interest in real estate investing in general. I've never done apartment buildings. I've done very light commercial and mostly single family homes. But tons of interest. First and foremost, why apartment buildings?
Well, Brad, I want to say that, and I don't want to say this like the wrong way, but you should. And the reason you should, and I'm going to tell you why, because that was a great question. But you should, and everybody should. And I believe that apartment investing should be part, or could be part of everybody's portfolio. I'm 70% of my net worth is in multifamily. And some people might be like, oh my God, that's way too much. Yeah, but I've been doing it for 20 years. So I know what I'm doing, and I don't feel, and I'm in, lots of different markets and lots of different deals. So it's possible to be diversified within an asset class. But there's so many reasons why apartments, and let me tell you why apartments, but also why apartments now, because this is very time sensitive. Okay, it's extremely time sensitive. 2022 is probably one of the best years ever to be all in apartments. And I just did a forecast on 2022, and there's 6 or 7 reasons why. Number one, when we look at the macroeconomics, there's a shortage of housing. And specifically, there's a shortage of rental housing. And so, especially during COVID, when all this construction got delayed, and we're all hearing about supply chain shortages and labor shortages, all these new units that were supposed to come online, a lot of them didn't, and they're still delayed. And so, when the pandemic hit, we had all these people lose their jobs, but now just about everybody's back to work, or will be in a very short period of time. So we have all these new households being formed and all these people looking for housing. And here's the thing, single family homes, the prices have shot up 20, 30, 40%. And there's I was just reading an article today that there's only $250,000 homes available nationwide for people that make between $75,000 and $100,000 a year in terms of the price of home they could buy. And just 2 years ago, there was 1 million homes available. So people making between $75,000 or $100,000 a year, there's very little inventory. They're having to overpay for a home. They still have to put 20% down. They got to save up money. The credit scores, this is not 2008 redo. They're not doing they're not doing 100% financing for people with no documentation. In fact, the financing criteria is still pretty tight, 20% down, 660 credit score. The price of single family homes is going up. So the demographic shift is happening in our country, and it's accelerating now with inflation, is people are, especially that mid-income family, is more likely to be a renter. So that plays into our advantage. Not like we're taking advantage of people, but it's a demographic trend that people need to be aware of. So that's huge right now. And that trend is going to continue for at least 2 to 3 more years, because it takes that long for new supply to be, developed and leased up. And so for the next 2 or 3 years, we have like this tremendous supply demand imbalance. So that's number one. Number two, what that's causing is it's causing rents to shoot way up. And in a town like yours in Austin, Texas, I mean, Austin rents have gone up, 20% in the last 12 months. Dallas, double digits. Tampa, 30%. Like all these Sunbelt areas where people are leaving the expensive coast of, East Coast, West Coast, California, New England, Seattle, so many people are leaving these areas. They're coming to warmer climates where the taxes are lower, the cost of living is lower, and they're more landlord and business friendly because they saw that those types of environments are more conducive to business and employment and everything. And so these areas, the rents are skyrocketing, Brad. And so again, that's not going to happen forever, but rents are going up. Occupancy is at an all-time high. The prices for apartment buildings, like if you're looking to invest, the prices are skyrocketing. And then say, hey, well, maybe I should wait. No, but if you wait, they're just going to get higher. So like I bought a deal last year for 13 million and it's worth 22 right now. It's worth 22 million. Crazy. I have $9 million in equity. And this is a deal that me and my wife own 82% of. So like, you'd say, oh yeah, but that's not your money. It's like, no, I owned 82% at 13 million. I own 82% now at 22 million. So like, just from one deal, like our net worth went up $7 million from like one deal. It's 154 units, and our net worth went up $7 million, and our cash flow went up 200,000 a year by one deal. So
I love that. Well, so I want to hit on that part because the timing is you drilled home, and the timing is super relevant. But you've been in it for 20 years. Right. So timing can't be the reason that you got into apartments. Right. So why apartments as an asset class versus commercial versus single family homes versus, high rises, whatever.
Yeah. Well, so let me get there too. So number one, you can make money in any of those things. Okay. And why I chose apartments is actually, it's pretty simple, is I went to a seminar and they only taught two types of real estate investing. They taught single family rentals and multifamily rentals. And I resonated more with multifamily.
Awesome.
And so 20 years ago, I made a decision to do multifamily and I never looked back. Now now I could fill in the blanks and say, oh my God, well, here's why. So like, besides that first deal that was 32, like now I only do large multifamily. So the why on that and the power of that is we're buying deals and hiring professional management companies. So like, unlike single family, like I'm not a landlord. I was asked to speak at a landlord conference and then I told them, well, I'm a business owner. I'm not really a landlord. And, the first thing I'm going to tell people at your conference is don't be a landlord. Because the landlord is like, oh, you do it yourself, right? It's like you buy a deal, you meet the tenant, you do the maintenance, you knock on the door, you collect rent. I mean, that's not what I do. And so why I love apartments as opposed to some other asset classes is that, when you buy like 60 units and up, you get economies of scale, you get non-recourse debt instead of recourse debt, which is, do you want to have personal liability or no personal liability? Do you want to have to qualify for the loan based on your personal income and credit or based on the income of the business? Okay, so there's a lot of advantages of buying 60 unit and up apartment buildings. Now, some of these aren't unique to apartments. They might be also, the same with, say, other commercial. But then when you look at commercial, like if you look at COVID, a lot of hotels got decimated, retail got decimated, apartments did amazing. Okay, people always need a place to live. And if you look at like a 100-unit apartment building, if your vacancy goes from 95% to 85%, you can lose 10 tenants and still cash flow. But if you have a commercial building, you either have one tenant or zero tenants. And usually that one tenant is going to do tenant improvements and make it somewhat customized to their business. And if they have to move out or go bankrupt, then you have a 100% vacancy that probably needs a lot more tenant improvements or modifications to get another tenant. Unless you can rent it to another, like if you had a restaurant, maybe you could, let's say I had a quick service restaurant that went out of business. I'm going to need to rent it to another quick service restaurant, or they're going to have to you spend a lot of money modifying it. Okay.
Sure.
So
of course, the flip side of that, right, is that those tenants, once they've sunk that money in, they've got a 3, 5, 10, 15-year lease, right? And then you have one tenant that, as long as their business is there and you underwrote the business effectively, it's a long-term tenant, right? So that's what the retail center owner would pitch, right? That's the thing that they lean on. But what you said that I think is relevant is that answers that almost directly is, yeah, but I don't manage the apartment building. I have a professional management company that does it and handles that side of it.
Well, here's the other beauty. See, right now, I don't want it. Like if I'm in commercial and I have a long-term lease, like a commercial lease, and I do understand a little bit about commercial because I'm a CCIM, certified commercial investment member, but I only focus on multifamily, right? But commercial leases tend to be longer term and they have escalating clauses like, well, the rent will go up 3% a year or whatever. Okay. Well, in residential multifamily, the leases are a year or 6 months. And so when you're in an inflationary market like we are now, Brad, you don't want to be tied into a long-term lease because we want to be able to be pivoting. And as the market demand is the demand is increasing and the supply is decreasing, like we're raising rents 20, 30% without doing any capital improvements. And I know some people out there might be like, well, that's not fair. And housing is a right. And we need to have rent control. And I'm not going to go political, but I just try to stay away from those areas. And that's why I don't invest in like California or, those types of environments, is because I want to be investing in a free market economy, like Florida, like Arizona, like Atlanta, like Texas. And so we have the ability, especially now, like during an inflationary market where these are 6 month to 1 year leases. And so we're able to raise rents, and apartments are a great hedge against inflation because the more they print money and the higher the rents go up, the more we can charge for rent and the more our value goes up as well, because apartments are valued by income. It's a phenomenal why apartments is because they're a great hedge against inflation, and the debt is and this is not unique to apartments, by the way, but we're still in a low interest rate environment. They're projected to go up in 2022, but they haven't really gone up dramatically yet, just incrementally. And so the agencies like Fannie and Freddie, they love loaning non-recourse loans on apartment buildings. They love them. And they don't do these for, say like mobile home parks and other types of, single family homes or duplexes or fourplexes and things like that.
So that's awesome. I think that's super helpful. If you're enjoying this, subscribe to the channel. It'll take you like 5 seconds. And then obviously you'll get to see more stuff that you'll also probably enjoy. In addition, though, if you like the content in general, the subscriptions are ultimately what drives the channel and what lets us get better guests on the show. We've had some killer guests. We need your help to continue filling that pipeline so we can get the best and the brightest to continue to teach you tactics and strategies to grow your business beyond $1 million. One of the things that becomes very, very, very relevant to entrepreneurs as they start to make substantial money is figuring out what to do with the money. And you mentioned a couple things, but one was, and I want to dive into deal structure, but this will play right into it because you mentioned sort of in passing as a footnote, the depreciation element of real estate and the benefits you get relative to taxation. And I think that that's a really big thing for people to look at. But if you could talk about accelerated depreciation and cost segregation for a second, that would be super helpful, because I think fundamentally that's a key element for wealthy people to think about when they're looking at investment tools.
It is. And again, there's a time sensitivity to that. So let me start with the time sensitive part and then I'll back into the concept. So
cool.
At the end of 2017, the tax laws changed, and those tax laws enable an apartment investor to, by the way, and cost segregation has always been around. And so let me just tell you what cost segregation is. Cost segregation is when you go into an apartment building and instead of taking a straight line depreciation where everything is going to be written off over 27.5 years, you could segment that building into different components like personal property, like flooring or countertops and cabinets. These things are not considered real property, Brad. So like the real property depreciates at 27.5 years, but personal property could depreciate at 5 or 15 years. And so what cost segregation does is it enables you to buy a building and accelerate your depreciation faster. So cost segregation has been around for 20 years, as long as I've been investing or longer. But what changed in 2017, and it's starting to phase out at the end of 2022, that's the time sensitive part, is for this 5-year period, you could take all that personal property in the cost segregation study, and instead of depreciating them over 5 or 15 years, you could take them all in year one. So
huge.
Here's an example, and I teach this in my course. So if I buy a $10 million building, let's say 1 million is the land value, so the land can't be depreciated. Okay, so I'm going to give you 3 scenarios, and hopefully your listeners could follow along with this. If we have 9 million of depreciable assets, then you just take 9 million, divide by 27.5, and that would be your annual depreciation for 27.5 years. So if you're following me there, and I'm just going to pull out my calculator and actually do this in real time, so I show you the real numbers. 9 million divided by 27.5. Okay, so yeah, it's 32,000 a year. Now, if you have cost segregation, where you could identify property that depreciates over 5 and 15 years, the net effect is you're going to get about double the amount of depreciation. So like cost segregation is something you should always do. But the net effect of being able to take that 5 and 15 year property in year one basically is, if I buy a $10 million deal and put $3 million down, I'm going to basically be able to write off the entire purchase price of the building in my down payment in year one. So like it's like a 10x depreciation. Okay. Right. I didn't do a good job explaining it. I have a really simple slide and pictorial that I could provide to anybody that wants it. But we'll grab it from you and send us the image. We'll put it in the show notes, maybe throw it up on the video when we cut this up. But the concept is really strong, and you did explain the concept pretty well, which is you're accelerating and depreciating. Instead of it over 5, 10, 15, or 27 years, a lot of it can be done in 1 year. And what that does, if you have ordinary income, meaning income you make from an active business, is it goes directly against your ordinary income. So you can wipe away huge tax liability with this accelerated depreciation. Yeah. So here's an example, like me and my wife, we're on our education platform. That's an 8-figure business. And we live off of, 10% of what we make and which is still 7 figures. Right. And so like in 2021, we invested $8 million into multifamily buildings. And so the ratio in terms of the write-off, it's about 1-to-1. And that's what the listeners need to know, is for every dollar they invest in multifamily, they're going to get about $1 in depreciation. And so we invested $8 million. So we're going to have an $8 million depreciation loss. $8 million depreciation loss. So how much tax are we going to pay when, let's say we make 12 million here and we invest 8 million and have an $8 million loss, and then, we have other sources of depreciation, from our buildings that we already own that are still on a depreciation schedule. I mean, we're paying virtually no tax. And so for high income earners out there that are making $1 million a year and paying $400,000 in taxes, because that's basically what they're paying is 40% or more. If they're self-employed, they could be paying 50 or 60% net tax. So a lot of people hear that and then they're saying, hey, how could I be a part of that? And they'll invest, $100, $200, $300, $500,000 into a multifamily deal, and they'll get that 1-to-1. If they invest $500,000, they might get a $500,000 write-off that could potentially go toward their earned income. Now I say potential because there's different nuances that, you have hurdles that have to be cleared between you and your CPA. And what it comes down to is depreciation is a passive loss. And so passive income, passive loss can only offset passive income, but good CPAs could find for a lot of entrepreneurs that a lot of their business is not earned ordinary income, that it's passive income.
Yeah. So I think there are two things that are worth highlighting there. One is that I believe, and you can correct me if I'm wrong or if you know differently here, but I believe you have to be a quote unquote real estate professional to take accelerated depreciation from a cost seg. Is that accurate?
Well, let me just say that I'm not qualified to give you a precise. Here's the answer. The disclaimer is I can't be given tax advice because I'm not a tax attorney or CPA. But here's what I do know. So what I do know is if you are a qualified real estate professional, then you can take, like I'm a qualified real estate professional. So my earned income from our education platform, we could invest that in multifamily and take that depreciation loss and offset our earned income because we're qualified real estate professionals.
Sorry to interrupt, but the footnote here is a qualified real estate professional, as far as the IRS is concerned in the United States, is somebody that invests at least 750 hours a year in real estate investment. And that's not necessarily going to be audited, but that is the definition of a qualified real estate investor.
Yeah, and that comes out to like 15 hours a week. But the second part of that, Brad, is if you have a full-time job, then the hours have to be more than your other line of work, which could be a nuance for something hard for people. But here's what I do know. Here's where it comes down to. Like my CPA is not a qualified real estate professional. He is a CPA, and that's what he does for a living. But he invests in my deals. Like he invested $300,000 in a deal, and he's going to get a $280,000 depreciation loss. And he said, Brad, I'm going to be able to deduct that from my income as a CPA. And so it's not true, according to my understanding, that you have to be a qualified real estate professional. There could be other circumstances, like here's a CPA that's investing in real estate that's able to deduct it. So what he explained to me is it came down to the breakdown of his CPA firm of how much income is passive versus how much income is not passive. And so I'm getting a little advanced here, and it's getting above my pay grade. But I guess I just want to communicate that for the listeners, they would need to have this conversation with a CPA that really understands real estate, cost segregation, bonus depreciation, and qualified real estate professional. Because I'm just here to tell you, a lot of my clients get bad advice from their CPAs. Yeah. Like one of my clients is a full-time real estate agent, which in my book, she's a real estate professional, but her CPA said, Brad, I can't deduct my depreciation losses from my realtor income. And I'm like, what? Talk to another CPA. And then she did. And the other CPA's like, of course you can do it.
Yeah. Yeah. I think that's a really relevant point. I've had many conversations, but today I approach the tax element of my life with a team. And I have a wealth advisor. I have a real estate attorney. I have several significant real estate investing friends, your specialty being in apartments, that I can talk to about these things, and a CPA that I can bounce things off of. And I think one of the things that's really important for people to know as they go down that journey is, sadly, and maybe to our great benefit, a lot of the IRS tax code is tremendously vague, perhaps deliberately, but it's open to interpretation. And ultimately, what you need to protect against is what you need to be prepared for is the quote unquote worst case, which is getting audited and being able to defend your position in an audit. And so you understanding that, and or your CPA understanding how you're going to defend that position in an audit, that's what makes me comfortable. And I'm not an operate in the gray space person, right? I'm very much, I want to know what the rules are. I want to know where I can do it, where I can't do it. But you have these areas where, things come down to stuff like intent. And, then I can defend that in an audit. I can show you what the intent was and why it was, et cetera. So I think that's great.
Yeah.
I think the context is super helpful there. Sumrok.
And here's the other thing, like according to my CPA, and one of the things I love about working with him is he's like, Brad, look, it's not black and white. Like the tax law is clear and this is what it says. And what gives, in my opinion, what gives the perception of it's black and white is like if you ask 5 opinions, you might get 5 different answers. And so now it might feel gray. But here's the thing, like, you know, when people talk about CPAs, like, let's think about the medicine field for a minute. You know, you don't go to a family doctor to have heart surgery. You go to I'm assuming a cardiologist, surgeon, right? Like,
yes.
And so people talk about CPAs as if they're all the same.
Yeah.
Okay. We don't talk that way about doctors. Like you have an orthopedic, you have an oncologist, you have a cardiologist, you have whatever. But then why do we say, oh, my CPA? And it's like, so the thing is, like, I do apartment investing and I have an education platform. I want to make sure that my CPA has direct experience in my business. Okay. Right. Because like some CPAs might specialize with law firms, for example, and I don't want to use that CPA that specializes in law firms so like my CPA works with a lot of people that own real estate, specifically multifamily real estate. And he works with a lot of people that have, you know, like a digital coaching platform or an in-person event company. And so he knows the nuances of this business inside and out. And that's what you want to find on your team is how are you making your money, and make sure your CPA is very fluent in your business.
Yeah, nope. 100% agree. So I want to tell me about, I want to talk just deal structure for a minute, because I know that you syndicate deals, and for people that don't do larger scale real estate investment, that's code for you put deals together and you bring investors into the picture to invest in these deals that you orchestrate. Is that a fair recap of syndication? And you can dig in a little bit deeper, but can you tell me how you structure those things and what that means to an investor? And I know that we're going to get into some terms that I want to break apart, because when people have never done this before, it's scary. You have a whole new lexicon, new language. You don't know what they mean, and you don't know what the returns are and how it pans out. So I think it'd be really helpful to break apart like a deal that you're working on now and how you offer it to investors.
Well, again, there's so many different ways to structure a deal, Brad, but I like to keep it really simple. And even though I've been doing it for 20 years, I'm going to tell you my favorite way to structure a deal is what I just call a straight split. And so, again, let's take a $10 million deal as an example. And in a $10 million deal, you need $3 million down, and we'll get a $7 million loan. And so that $3 million down, like let's say I only put up $100,000. Okay, so I'm putting up like 2.5% of the money, right? And so now, and then the investors are going to put up 2.9 million. So they're putting up, if my math is right, they're putting up 97.5% of the money. But the way I would propose structuring that, and this is actually how I do it in my own deals and in my educational platform and my content, is I just say, look, the easiest way to do it, because if you can explain to your investors how you get paid and they get paid in one simple sentence, it's really easy, and complexity kills, right? Tony Robbins teaches that. If you want to confuse people, then make it complex. And once people are confused, then they don't make a decision. So, Brad, I would just say, hey, look, I'm going to put up 2% of the money, but I'm going to take 20% of the profit. So every dollar that comes out of the deal, like if this $10 million deal, and we have a $3 million down payment, and let's say this deal generates a 10% cash return. So this deal is going to generate $300,000 a year. $60,000 is going to go to me, which is 20%. And then $240,000 is going to go to all the investors based on your pro rata capital contribution. That's really simple to explain, right? And the same thing, I'd say, hey, when we sell the deal, 20% of the profit, all the investors will get their capital back, but let's say we buy it for 10 and sell it for 15. Well, that 5 million is going to be split 80-20. Okay. So that is the simplest way to structure a deal. That's how I do most of mine. Now, I've done preferred returns with waterfalls and all these complex things. But the truth is that the simpler you can make it, the better. And I think I don't know, I'm not sure. I don't want to speak for Grant Cardone, but I think he does the same thing. He might take a bigger split, but the last time I heard, at Cardone Capital, he takes 35% of every penny that comes out of the deal. And it's just simple. It's like people can grasp it. It's a really simple way to structure it. And so then, and I'll usually take an acquisition fee, a 1% acquisition fee, and maybe a fee if I refinance the deal, where I get 20% of the refinance proceeds, 20% of the sales proceeds, 20% of the cash flow.
Well, let's talk about the complexity. Let's take a step into the complexity for a minute, because I love that approach. I also know that for the litany of people that hear this, if they've run into a development project, a commercial project of a variety of sorts, an apartment building, it probably wasn't that simple. And it was probably somebody that was talking about pref, and they probably got confused and scared and didn't know what the return was going to look like, and it went right past them, right? Or they took the time to sit and talk through it. So can you take one step into complexity and say, okay, here's another structure that people use, and this is what it means?
Yeah, so a preferred return is really popular in syndication. And again, syndication is basically just pooling money together. And in a syndication, there's usually a general partner and then limited partners. And the GP is the person or the subset of the people that are putting the deal together and structuring the deal, right? So and by the way, some investors like the preferred return because a preferred return means you get paid first. So in an 80-20 split, if the deal makes $1, 80% goes to the passive investors or the limited partners, and 20% would go to the syndicator or the general partner. So that's easy, and we already covered that. In a preferred return, it might be, let's say this deal spits out, it's projected to spit out $300,000 a year. So we know how the 80-20 split would work. But a preferred return might say, hey, look, the first 7% goes straight to the investors. Now, why do they like that? Well, what if the deal doesn't spit out $300,000? Because $300,000 is a 10% return. What if the deal only spits out a 6% return the first year? Well, in that case, Brad, the passive investors would get everything, because if they're getting a 7% pref, they get the first 6%. And then I would actually accumulate 1% from next year's returns that I would have to pay them before I get anything.
As the general partner.
So yeah, as a general partner. So some passive investors, limited partners, they like the concept of a preferred return because they get paid first. But then here's the downside or the upside to that. If I'm going to offer my investors a preferred return, I'm going to take more of the upside. So I might offer Brad, maybe I'd say, hey, option 1 is I'm going to do a straight 80-20 split. And option 2 is I'm going to give you a 7% pref, which means the first 7% goes to the limited partners before I get anything. But then I might say, hey, after that 7%, we split everything 50-50. So now my upside is tremendously higher, and the upside of the passive investors is actually tremendously lower. Or, and you can do the math on that, right? And so if I'm buying, I know people that do pref returns, and if they think they're really going to knock it out of the park, then they'll offer their investors a preferred return, but they'll take a bigger chunk of the upside because they're going to make their money on the upside of the deal.
So let me see if I can recap that thought train that you went down. One is the preferred return is going to give you maybe a guaranteed return, but certainly a return. A guaranteed return, at least guaranteed by the general partner, and it's going to be paid first before the general partner makes money on the deal.
Well, I would refrain from using guaranteed because
yes,
there still has to be a return.
Sure.
Okay. So let's say, we do a deal in year one, there is no return. But if they got a 7% pref, that 7% pref would carry forward to year two. And let's say for some reason there's no return in year two, then that return would carry forward. And then if we sold it, then I would owe them 7% from year one, 7% from year two, 7% from year three before I get anything. So it's not a guaranteed return, but they're getting paid before I get paid as the GP.
Yep.
And so that's the concept of preferred return.
Perfect.
And then so the upside for the passive investor is that they're getting paid first. The downside is their upside is going to be limited because in exchange for having a more secure and being paid first, they're going to get less of the upside. Now, the other caveat is the bank is always getting paid first, and all the vendors all get paid first. But I'm talking about once there's profit. So a straight split model, it's just splitting and we're getting paid at the same time. Whereas with a preferred return, I'm paying the investors first.
Yeah, I think that's super helpful.
Yeah.
Awesome. Well, I know we're coming at time here. I want to make sure that people have the ability to find you. Where can they find you? Both for if they want to learn about investing in apartment complexes, and also if they want to learn about actually just partnering with you for deals. Yeah,
the best way to go is my website, which is my first and last name, and it's just Brad Sumrok, BradSumrok.com. There's no C in my last name. And you'll also find me on Instagram and Facebook, in LinkedIn, again, Brad Sumrok. And, that's my main thing. Those are my two main things. But other people, Brad, we talk about personal brands, and the other interests that I have are fitness and health and cars. And, I like exotic cars and travel and stuff. So when they talk about personal brand, I have some people that look me up just because they're interested in some of the other cool stuff that I like to do that have nothing to do with my businesses. But most of the people that look me up are interested in apartment investing.
Cool. Well, I certainly know that we'll have some listening, myself included. So I think that's been super helpful, man. I appreciate you taking time out today.
Yeah, man. Thank you so much. And I hope there's some valuable information in here. I think there is, by the way.
Oh, definitely. No question about it. Well, I'll look forward to seeing you at the next War Room, man.
Yeah, thanks, man.
My director of marketing told me to read this. Thank you for tuning in to Beyond a Million. If you liked this podcast, please subscribe and drop a comment below. We'd love to know your thoughts. If you want to learn the strategies that our guests such as Neil Patel, Amy Porterfield, and Grant Cardone use to scale their business, you can find more episodes on our website at beyondamillion.com.